Okay, and I wanted to talk about the wealth building formula. This is a fundamental strategy, and it identifies stocks with the greatest growth potential. And I have a unique way of measuring growth. So there's a lot of ways to measure growth. You could measure the earnings, the sales growth, the cash flow, return on equity, and low debt to equity ratios. So the wealth building formula takes all those into account with one simple measurement. So let's talk a little bit about stock ownership. When you buy stock, you become a partial owner of the company and you own a percentage of the company. Now your percentage of ownership is known as stockholders' equity. And stockholders' equity, essentially the net worth of a company, and it's calculated by subtracting the debt from the assets, which gives you the net value or the net equity of the company. So if a company is liquidated, the stockholders' equity would equate approximately to the breakup value or the liquidation value of a company. So I'm going to use an example here. United Healthcare, stockholders' equity is about $15 per share. So when you buy United Healthcare stock, you're buying about $15 of equity. If you buy 100 shares, you're buying about $1,500 of net equity. Let's assume that United Healthcare was liquidated. Our equity in the company should be about, if we own 100 shares, should be about $1,500 after the debts are paid. So the stockholders' equity, I like to call that intrinsic value because that represents the true value or true worth of your stock. United Healthcare has been able to grow its stockholders' equity at a 30% annual compounded growth rate since 1990. So that's an indication that United Health is very profitable, it has very strong earnings growth, and it has a very low debt to equity ratio, because if they had a lot of debt, it would reduce that stockholders' equity and they wouldn't have a high growth rate like that. So typically the companies that can grow their equity at a high rate typically have low debt, they're highly profitable, they're able to retain their earnings, and retained earnings are the biggest percentage normally of equity in a company. So it's a really good measure of the profitability of the company and the ability of the company to maintain those earnings. So United Health doesn't have a large capital expenditures. It has a low debt level. So it's able to retain its earnings and increase its equity each year. Only a small portion of its earnings is required to service its debt. Normally, the company's retained earnings are the biggest component of stockholders' equity, so it's a good way to measure the profitability of a company. Because United Health has a high earnings growth rate and it is able to retain those earnings, it's been able to grow its stockholders' equity at a fast rate of around 31%. Let's assume that back in 1990, we bought 100 shares of United Health and it had $15 of equity per share, and let's just assume our equity portion of our investment was $1,500. By 2000, I think I took this calculation in 2007 or 2008, the equity would have grown from $1,500 to $151,000. So the equity in the company grew more than, it doubled more than 100 times over that period. It's a sign that it's a pretty healthy company and it's growing and it's retaining its earnings. And then I found that the stock price also kind of parallels the growth in equity, and it's a good gauge, a good indication. Over the same period, the stock price appreciated around 35%. compounded growth rate over the same period of time. So there's a strong correlation between the growth in the equity or intrinsic value and the stock price increase. So if you can measure that equity growth, you'll see some companies have a high equity growth. They're usually the ones that the stock price also follows. You'll see companies that have a low or negative growth in equity, and a lot of times their stock doesn't do well. It's the price decreases. So there's a good correlation there. So as the company grows its equity, the true value of your investment is also growing, and ultimately that's the reason we invest in stocks, because your investment is growing, your equity is growing, and you only get that with stocks. You don't get that with other investments. So the growth in equity has created trillions of dollars of economic value to shareholders, and it's the foundation of a capitalist economy. The stock provides the capital that creates companies and allows them to grow. As the intrinsic value of a company grows, the company can increase its services or products, and in turn that can further increase the earnings. So a healthy growth rate in equity is always a sign that the company's doing well. So now your investment in a company that's growing its equity is different than buying real estate or precious metals or commodities, hoping that somebody's going to pay you more than what you paid, because that's just price speculation. So the real estate, commodities, and precious metals, they don't have the potential to grow their equity like stocks do. So over time, the ability of companies to increase their equity or intrinsic value has always allowed stocks to outperform other types of investments. I did some historical testing with some what I call wealth building stocks. If the company is able to grow its equity at a 10% rate or higher, annual rate or higher, I consider that a wealth building formula stock. So I took some wealth building formula stocks and did these 8 stocks and did some historical tests from 1990 to January of 2007. And these results include dividends but not commissions. So these 10 stocks represent a broad cross-section of industries from biotechnology to coffee houses. So there's a little bit of everything in here: insurance, healthcare plans, diagnostic products, home builder, energy, coffee houses, brokerage, medical instruments, air freight, and biotechnology. So it's a broad cross-section of industries. And a $10,000 investment divided equally between these 10 stocks since 1990 grew to over $6 million.